In early 2023, Elon Musk shocked the world with the first ever price cuts to existing models of Tesla cars. For some models, the prices were slashed by as much as 20%. Demand for EVs had previously been considered unlimited, and Musk had previously touted Tesla's ability to sell out 100% of its production capacity without them having to do any advertising. But now, with more of the general population already owning an electric vehicle and new EV models entering the market at all price ranges, it seems like the market has finally reached peak EV demand. In fact, with so much investment in electric vehicle technology from both startups and the traditional automakers, the market has been flooded with budget-friendly and luxury EVs alike. In 2024, the prices of used EVs fell to below the prices of used gas cars for the first time ever, an indication that the balance of supply and demand for EVs has tipped in the opposite direction. In the past year alone, prices of both used and new EVs have fallen by as much as 40%. Of the seemingly endless supply of brand new EV startups that went public during the SPAC mania of 2021, the vast majority of them either no longer exist or are on the brink of bankruptcy. So what happened? In this video, we'll dive deep into the current electric vehicle winter and uncover why what was once the economy's hottest industry is now struggling to survive. Before the introduction of large quantities of affordable, mass-market EVs, it seemed like demand for EVs was unlimited. The high-end Tesla Model S, released in 2012, was the first widely available EV, and for most of the 2010s, it was supply-constrained. Each quarter, Tesla updated investors about production deliveries of Tesla cars. The status of the production ramp was usually the focus of these updates. For example, in the first quarter of 2016, Tesla reported that even though production of the Model S and the similarly priced Model X had increased by 50% compared to the previous year, challenges with production were still preventing them from fulfilling the order backlog. Ramping production was their main challenge when they first started delivering their first mass-market Model 3s in 2017 too. Customers placed over 500,000 reservations for the Model 3 in the first year, which is more than double the total number of cars that Tesla was able to deliver in 2018, the first full year the Model 3 was available in. Wait times for the new affordable EV were about 18 months. All signs pointed to demand outstripping supply, and even as late as 2021, there were months-long wait times for Teslas. Large-scale production of mass-market EVs is the key to a sustainably profitable EV business. Tesla continued building out more production capacity for the affordable Models 3 and Y, with new gigafactories in Texas and Shanghai in order to meet the demand. But up until those gigafactories started mass production of affordable Models 3 and Y cars in 2021 and 2022, supply of affordable EVs from any brand was still relatively low. Coinciding with the production ramp of the Models 3 and Y, other companies also started introducing their own mass-market EV models. The Ford Mustang Mach-E, one of the most popular affordable EVs today, started selling in 2021. Chevrolet's flagship affordable EV, the Equinox EV, hit the market in 2023, and while its predecessor, the Chevy Bolt, had already been available for years, the Bolt was plagued with technical issues and numerous recalls, and was discontinued in 2023. So for the first time ever, around 2022 and 2023, mass-market EVs finally started becoming mainstream. Now that it's been several quarters since this inflection point in EV supply, just how well has demand kept up? To answer that, we need to look at EV production, sales volumes, and prices over the last couple of years. In January of 2023, Tesla slashed prices of its cars to bolster demand. Then, we started seeing reports from other automakers about price cuts, reductions in production volumes, and reduced investment in EV research and development. So what happened? Were people no longer interested in EVs? According to the US Energy Information Administration, the share of new vehicle sales made up by EVs fell from 8.1% in the fourth quarter of 2023 to 7% in the first quarter of 2024. This decrease was most pronounced in the mass market segment, where EVs' share of new sales fell by almost 20%. This was the first quarter since the pandemic that saw EVs' share shrink. But there was real data as far back as early 2023 that demand for mass market EVs was disappointing. Ford is the brand with the most popular EV model behind Tesla, the Mustang Mach-E. It is a mass-market compact crossover SUV that competes with the likes of the Tesla Model Y and other compact SUVs. Ford is also the only major EV maker to report the details of its EV sales each quarter. Starting in the second quarter of 2023, Ford increased its wholesale deliveries of EVs to dealerships by almost 4 times, but actual sales to consumers of those EVs only increased by about 30%. For the rest of 2023, Ford continued to ship large numbers of EVs to dealerships, but EV sales to consumers continued to lag. Sales of EVs actually decreased in the fourth quarter. This overproduction happened with other manufacturers as well, and dealership lots began filling up with unsold EVs. By the end of 2023, according to Cox data, EV inventories more than doubled to a 4-month supply, compared to about a 2.5-month supply across all types of cars. This has forced the automakers to slash prices in order to move EV inventory. Meanwhile, regular gas vehicle sales seem to have remained healthy, with wholesale deliveries to Ford dealerships roughly in line with sales to consumers in each of the last 4 quarters. So why is demand for mass-market EVs so massively underperformed expectations? It can be attributed roughly to 2 main factors: economic and perception. The most significant economic influence has been the rise in interest rates. In an effort to combat inflation, central banks, including the Federal Reserve, have increased short-term interest rates, leading to higher borrowing costs throughout the economy. For potential EV buyers, this translates to more expensive auto loans, which can deter large purchases. In the US, as the Fed began its rate hiking campaign in 2022, the average rates on auto loans increased from just under 4% in January of 2022 to almost 8% today. Regulatory changes have also made the financial prospect of buying an EV even worse. In the US, a $7,500 federal tax credit has been available to EV buyers since 2009. This effectively decreases the cost to the buyer by $7,500. In 2022, the Inflation Reduction Act added stricter requirements for both vehicle eligibility and consumer qualifications. These changes have made fewer EV models eligible for incentives. For example, only cars under $55,000 or trucks and SUVs under $80,000 are eligible for the $7,500 tax credit. That excludes popular models like the Tesla Model S, the Lucid Air, and all but the cheapest versions of the Rivian R1S lineup. There are also restrictions on the income level of the buyer, mineral and battery components of the EVs, and where the EVs are assembled. All of these have made taking advantage of the federal subsidies less lucrative and more complicated for all EV purchases. But perhaps the more important change in EV demand has been deteriorating consumer sentiment about EVs in general. Initially admired for their innovation and environmental benefits, EVs had a cool factor that significantly boosted their appeal. This allure is fading as EVs become more commonplace. It's now been more than a decade since the release of the Model S. In the mid to late 2010s, whenever you saw a Tesla car on the road, it was very noteworthy since mass-market EVs were brand new. Now, that newness has worn off, and electric vehicles of any kind are not very noticeable. Additionally, the entrance of numerous affordable and lower-priced EV models has democratized access to electric mobility, eroding the exclusivity once associated with these vehicles. All these factors have had a measurable impact on people's thoughts on buying EVs. Last year, a poll from Gallup showed that 43% of Americans would consider buying an EV. This year, that number has fallen to just 35%. As if the softness in demand for EVs wasn't bad enough, electric vehicle production is also a huge challenge for EV makers. Electric vehicles work completely differently from regular gas vehicles, as they use a battery and electric motor instead of an internal combustion engine. Although in many ways electric vehicles are mechanically simpler than gas vehicles, they are still significantly more expensive to build. Take for instance the battery, which is the single biggest cost in building an EV. An average EV battery is enormous, about 10,000 times the size of a phone battery. It also requires large amounts of expensive materials, including cobalt, which is mostly mined in the Congo, lithium, which is mostly refined in China, and nickel, which is toxic in large doses. Shortages of these materials caused huge price surges in 2021 and 2022, and even after production increased and prices normalized throughout 2023, batteries remained the most expensive part of EVs. According to Bloomberg, the average cost of the batteries in EVs was about $139 per kilowatt hour in 2023. Most electric vehicles have between 60 and 100 kilowatt hours, giving a total cost of about $11,000 per vehicle. That's almost a third of the current list price of a Tesla Model 3, eaten up by the battery alone. It's a major disadvantage that EVs have when it comes to profitability, especially since it cannot be solved simply by ramping up EV production numbers. The electrical regulation of battery packs and the large amount of power that they produce is another unique challenge of EV production. Controlling the power that gets delivered from the battery to the motors requires regulating huge electrical currents efficiently, something that requires sophisticated semiconductor hardware as well as control software. These systems not only have to perfectly control the flow of power between the battery and motors, they also have to effectively manage the heat generated by both the battery and the motors. Both during driving and charging, batteries generate significant amounts of heat. In a worst-case scenario, this can lead to violent fires, and even small amounts of heat can significantly degrade the life of the battery. If you've ever had a cell phone whose battery life degraded over the course of a few years, one of the biggest factors in the degradation is heat during intense use. For EVs to not suffer the same fate, they must have systems to protect the battery from this heat. But for EVs, the size of the batteries is about 10,000 times bigger than for cell phones. These types of technical and software challenges have proven difficult even for some major players in the EV space. In June of 2024, Volkswagen announced a multi-billion-dollar deal to invest in Rivian. One of the reasons they chose to make this investment in an otherwise floundering EV startup is because of Rivian's technological IP. Volkswagen has historically had little experience in the software and other technologies needed for modern EVs. So in 2020, they set up a unit called CARIAD to develop the software for its new vehicles, but that unit has been plagued by delays and other difficulties. So now they're taking a different approach by effectively buying the IP they need from Rivian. This example shows just how difficult it is, even for some of the most well-capitalized automakers, to develop the technology necessary for an EV model. Between the challenges to the demand picture and the difficulties in manufacturing, EV makers have been struggling in the last couple years. Ford is the only traditional automaker to disclose the operating results for its EV segment, and the numbers don't look good. They lost a staggering $132,000 for every single one of the EVs they sold in the last quarter, as of the time of recording this video. The massive losses were a result of a drop in number of vehicles sold, price reductions that reduced the revenue earned per car, and ongoing research and development investments in EV technology. Even Tesla, the only EV maker in the US to have become consistently profitable, lost more than half of its profit in the last quarter. Again, it was the result of lower volume sold at lower prices than in the same quarter last year. Tesla has reduced the prices of its cars several times since 2022. According to Skills AI, the average Tesla is now a third cheaper than it was a year and a half ago. People just don't want EVs as much as they used to, and when they do buy EVs, they're not willing to pay as much. Almost all of the major EV makers have responded to this new reality with strategic pivots. In April of this year, Tesla announced that it planned to lay off 10% of its global workforce amid an effort to streamline operations and reduce costs. Ford announced that a highly anticipated new $3.5 billion battery facility under construction in Michigan would be vastly scaled back by billions of dollars. It'll now have only about half of the originally planned production capacity. And GM slashed its total EV production guidance by 50,000 cars for 2024, while at the same time announcing a new $6 billion share buyback authorization. All of these companies are responding rationally to the new reality that EV demand just doesn't justify the level of investment in production that they've been expecting over the past 5 years. To get a sense of just how difficult the EV market has become, consider the example of Lucid, one of the most highly rated electric vehicle makers today. The Lucid Air premium sedan is one of the most high-end electric vehicles on the market today, and has garnered overwhelmingly positive reviews from critics and customers. And yet, there's nothing premium about the company's financial results. After peaking in 2022, their revenue pulled back in 2023, and has since flatlined. Even worse, they are nowhere near breaking even on a gross profit basis. Their cost of goods sold is still more than double their revenue, meaning that it costs them more than 2 times as much to produce each one of their cars as they're able to sell them for. And that's even before R&D and selling, general and administrative costs, which are each more than revenue as well. Despite efforts to spur demand and cut costs, their quarterly operating losses still exceed $500 million. It's hard to see how Lucid can become a profitable enterprise unless something in the market drastically changes. The story is similar at other automakers. We've already discussed how Ford is losing well over $100,000 for each electric vehicle it sells. GM has also admitted that it's still selling EVs at a loss. Rivian, perhaps the most successful EV startup after Tesla, is so cash-strapped that it was forced to sign a deal that gives a key competitor access to some of its most valuable IP just for a few quarters worth of capital. Tesla is the only US-based company that sells EVs at a profit, and even they are having to do layoffs and price cuts. Since peaking in 2022, Tesla's profits have collapsed. It's been over a decade since the first mass-produced electric vehicle was released by Tesla. In the first 5 or even 10 years, they were seen as luxurious toys for business executives, retired doctors, or other wealthy individuals. But since then, a lot has changed, and the idea of owning an electric vehicle no longer carries the same allure. Around 2021, countless EV startups entered the market, trying to take a piece of what seemed to be endless demand. In 2021 alone, at least 15 EV-related companies went public via SPAC, and that's not even including the established automakers. Now, there are too many EVs available given the current level of demand. We are in a new reality. EVs have been commoditized, and given the intense competition from numerous suppliers, it has now become one of the worst markets for a company to be in. Alright guys, that wraps it up for today's video. What do you think about the current EV market? Do you think public perception around EVs has fallen off in the last couple years? Let us know in the comments section below. In the meantime, thank you so much for watching and we'll see you in the next one. Wall Street Millennial, signing out.